Hello, greetings, and welcome to Dividend Blasters. This is our seventh video. The focus is three companies just declared dividend increases: Coca-Cola, Louisiana Pacific, and Next Era Energy. We're going to discuss these. First, however, I would kindly ask if you would please give this video a like and subscribe to this channel, Dividend Blasters. Quick disclaimer: I am not a financial advisor. The purpose of this video is for information and education. It reflects my own personal opinions and assessments of any investment that I discuss on this channel. Please do your own research and consult a financial advisor prior to making financial decisions. As an aside, I've been investing for more than 30 years. However, I also employ a financial advisor, a licensed professional, and I consult with them before all major investment decisions. Question: why invest in dividend growth stocks? I've posed this question in previous videos, and I'm going to quickly answer them. First and foremost, establishing passive income. Separate and distinct from your job, we all should strive for financial independence. And the best way to do that is to build passive income. The best way to do that is through dividend growth stocks. Number two, investing in dividend growth stocks can act as a hedge against inflation when you have passive income. Inflation is a tax on your hard-earned dollars. The best way to hedge against that and to counteract that is to have more income, an extra income stream, if you will. Third, building wealth over time. That's a great advantage of investing in dividend growth stocks. Investing in great companies that pay increasing dividends over a long period of time will get you financial independence and help you build that wealth. This is much more reasonable and rational than trying to stock pick the next moonshot, whether it be Apple, Meta, Microsoft, Google, Tesla. We all want to get in at the right time and pick these next moonshots, but it's very difficult. Last but not least, the power of the DRIP, dividend reinvestment planning. We know about the DRIP, and I've spoken a lot about the snowball effect of dividend reinvesting. It's very simple. You're an investor, you get a quarterly dividend. You reinvest all your dividends. Presumably, you're not yet retired and you're still working. And if you're smart, and you are because you're listening to my channel, you're reinvesting your entire dividend back into your holdings. Next quarter, you're going to get another dividend payment, and it's going to be bigger. The dividend payment's bigger because your holdings are bigger, because you already reinvested your dividends. So now you're going to get this bigger dividend payment, and you're going to reinvest that into your larger holdings, which are going to get larger, and they're going to generate a larger dividend payment. On and on and on, this wonderful thing called the DRIP goes. Key criteria when evaluating dividend growth investments. If you're finding an investment that is that you're not invested in, you're going to look at the ex-dividend date. And if you're not in and you want to get in, you got to get in before the ex-dividend date. You got to get your buy-in to get your dividend payment this quarter. Otherwise, you're going to miss out and have to wait until the next quarter. The dividend yield. Really, what that is the reflection of the dividend payment relative to the price of the stock or the ETF. Typically, I like to see a dividend yield of 2 to 3% on a dividend growth investment. Dividend growth rate. Basically, that's a reflection of how much annually the company is increasing the dividend payment or the yield, if you will. I would typically like to see an annual growth rate of 5 to 6% each and every year, and I look at something called the 5-year dividend growth rate. We call it the CAGR or the CAGR, the compounded annual growth rate. Ideally, I like to see something in the range of 10% when combining the yield and the growth rate. 3 for the dividend yield, 6 to 7 for the growth rate. Sometimes, you know what, I've bought investments that don't quite meet that threshold. It's a rule of thumb that I look for, the 10%, but I try to be flexible. If I see good intangibles and good promise in the investment, the dividend payout ratio, this is really a reflection of the dividend payment versus the earnings. I like to see something in the range of 20 to 60% ratio. I don't like to see anything more than 80%. On occasion, I've broken my rule, and if I see something that I think has promise, um, I've done that. I've bought investments that had a greater than 80% ratio. Not often, rarely, and not by much. Usually, I stay within that 20 to 60% range. Dividend growth streak. That's an important metric. That answers the question of how many years consecutively has the company increased the dividend yield. Have they done it 4 or 5 years? I like to see that as a minimum. We've spoken about in previous videos dividend aristocrats, companies that have done it for 25 consecutive years. Okay, like an AbbVie or a Chevron. We've mentioned dividend kings that have done it for more than 50 years, like a Johnson and Johnson or a Coca-Cola, which is one of the companies we'll address today. They've done it for 60 years. Last but not least, cash flow. Cash flow is the lifeblood of a company. You like to see robust, growing cash flow. First company, Coca-Cola, they just announced Thursday, February 16th, that they're increasing their dividend by 4.5%. So this is for first quarter FY23. They're increasing it from 44 cents a share to 46 cents a share. Doesn't sound like a lot, but that's a healthy increase, 4.5%, especially for a very large, stable, established company. Company profile. We know what Coca-Cola is. We've all had Coca-Cola. Uh, they're headquartered in Atlanta, and they've been in operation. They were founded in 1886. Interestingly, if you ever go to Atlanta, I advise you to go to the Coca-Cola Museum. I haven't been there in many years, but I did go there about 30 years ago. It was wonderful. Okay, getting to the skinny. Coca-Cola has a dividend yield of 3.06% and the dividend growth rate, the CAGR, for the last 5 years of 3.53%. Together, that is less than 10%. It's 6.56. However, I'd say there's a qualifying factor to consider. First and foremost, it's Coca-Cola. It's a marquee brand. It's a great company. Look at the dividend growth streak, 60 years. They are a dividend king. They've been doing it forever. They've increased their dividend payment for 60 consecutive years. So they've been a king for 10 years. They are dividend royalty. Anyway, as I mentioned, they just declared the dividend increase Thursday. I got it circled there, the 16th. The ex-dividend date is March 16th. So if you want to get in and you're not in, or if you're in and you want to increase your holdings, you got to make your buy by March 16th. Payout is April 3rd. Just for context, I've included a couple of screenshots. You can see the last year, and then you can also see the last 5 years. The last year, they were down a little, and I would say a little under 4%. And then in the last 5 years, they were up over 38%. So I got to say, though, as we know, a lot of people were down last year. 2022 was a very bad year for stock investors. It was very volatile, and there were a lot of losses. A lot of stocks retreated. I tend to think, my own opinion, it's a one-off. It's an anomaly. I do a lot of studying of numbers and trends, and you look at performance of companies like the Microsofts and the Apples, over the last 25, 30 years, and they have a lot of good growth, steady growth. They might have a year or two here and there where they lose a lot, like in 2008 and in 2000. Okay, those were seismic shifts in the investment world. 2000 was the dot-com bubble. A lot of companies lost value. 2008 was the subprime crisis. That was a problem. A lot of companies lost value, but they got it back. I'm thinking that maybe that might be what this is. We pray for the best, prepare for the worst. We analyze, we plan, we calibrate, we manage our risk. That's kind of what I'm thinking right now. Anyway, back to the numbers. It's currently trading at 60 bucks. The range for the last year is between 54 and 67. It's not bad. The market cap is 260 billion. It's a big company. The PE ratio is 23.2. It's a little higher than its competitors in its sector, which is about a little more than 20. But it's Coke. It's a marquee brand. And honestly, I see this with a lot of investments that are marquee brands. They get bid up because people want to own them. Other companies in the same sector, which may not be marquee brands, they may be good products, they don't get that same benefit. And so they don't get that same push, if you will. I did mention that 2022 was a rough year for everybody. They didn't do too bad, even though they did retreat a little bit. But look at the beta. The beta is a measure of risk or price volatility. And I have two metrics, one for the last 24 months, one for the last 60. The beta has increased ever so slightly from 60 months to the last 24 months. But let's just look at the last 24 months. It's 0.6. 0.6, folks, is not bad. The beta is a measure relative to the market, the larger market, the S&P 500. And so basically what this is saying is that Coca-Cola as an investment is less volatile by about 40% than the market. So that to me is a very stable investment. And the fact that they're increasing their dividend, I think, is fantastic. Now, you look at the payout ratio, it's a little bit high, but again, it's Coca-Cola. And Coca-Cola is not going anywhere. It's been around and it's going to be around for a while. Next one, Louisiana Pacific. So just yesterday, Friday, February 17th, Louisiana Pacific just announced that they're increasing their first quarter dividend payment up to 24 cents per share. It's a 9% increase. Previously, it was 22 cents for Q4 of last year. 9% is a monster increase. That is massive. To me, when I see that, that's a really good signal that the company has cash. Their earnings are high. They can easily meet their commitments and obligations, their debt. They have good cash flow, and they can meet their dividend. That's a good signal. I got a little bit of background here. You can read it at your leisure. I'm not going to read the whole thing. But I just will say that they're headquartered in Nashville, and they were founded in 1972, and they manufacture engineered wood building products for home builders, home remodelers, and homeowners. Now, as an aside, we know that the home building market has been a little bit depressed over the last couple years. for a couple of reasons. The pandemic, COVID, that has slowed things down. We're kind of at the tail end of that. It's still out there, but we're kind of pulling through that. But also now inflation. So that will affect companies like this. They're part of that supply chain for home building, but they're increasing their dividend 9%. Wow, pretty impressive. So let's take a look at the numbers. The dividend yield is 1.48%. It's a modest yield. It's less than their competitors by about 0.43%. Take a look at the earnings per share, more than $12, significantly greater by a factor of 12 over the dividend per share, which is less than $1. I think that's impressive. That to me tells me they can meet that. Their earnings are significant, that they can meet their dividend. I would look at a few other things, but earnings per share is a good metric. Dividend payout ratio is small. It's 6.35%. Uh, I like the 20 to 60% range, but I think if it's smaller, that's okay. That's okay. They're meeting it. They're making it. I'd rather see a smaller yield and a larger dividend growth rate. And honestly, when I see a payout ratio that's small, I can dig that. That's fine. I was looking for a 5-year growth rate. They didn't have one listed. I just found the 1-year growth rate, which is very high. It's 30%. But I did do a little digging into the dividend history, and the last 4 years, they have increased their dividend fairly consistently annually. I think maybe 10 or 15% in total. But Seeking Alpha didn't have that calculated. So I just did a quick eyeball, and that's my estimation of it. If it's 30% for the last year, it's greater, much greater than their competitors in their sector. Dividend growth streak of 4 years. I can dig that. They're a quarterly company, a dividend company. They just declared yesterday, the 17th. If you want to get in and get this dividend that's being increased, you got to get your buy-in before March 9th. And then the payout would be March 31st. The current price is $64.80. You'll notice at the top I have a couple of screenshots, price performance for the last 1 year and then the last 5 years. The last 1 year, they were down a little bit by about 5%. It's 2022 was a rough year. Home building was depressed. I don't think it's that bad. And I look at some of the other metrics around here, like the PE ratio. The PE ratio is only 5 and some change, and compared to their competitors, it's significantly less, which was almost 14. So you got to look at some of these measures kind of holistically and read the tea leaves. There has been some volatility in the last year. You can see that it's gone anywhere from 48 to 70. It's settled in right now around 64, and these prices are as of Friday the 17th. Market cap is a little more than 4.5 billion, 4.65 billion. The beta is high, I believe, but I think you need to take it in context. So when I reported the beta on Coca-Cola, I had two metrics, 24 months and 60 months. And I got that out of Seeking Alpha, which is a wonderful resource. Seeking Alpha did not have a beta metric reported for Louisiana Pacific. And I looked and I looked and I couldn't find it. So I went to my TD Ameritrade account and I looked up LPX, and they reported just one beta metric, 1.6. They didn't say if it was 24 months or 60 months, but my presumption is it's just for the last 12 months. And you know what? We know that 2022 was a difficult year. So there was more volatility last year relative to the market. But I think that last year is a little bit of an anomaly. And this year may be an anomaly too, especially the last half of the year, from what I'm hearing. So I would kind of take it in context. that the housing market has been depressed, but this company appears to be in really good shape based on some of the metrics that I'm looking at. So that's my opinion. I again, I think that this is a good company to invest in, and I would jump in. Uh, Listen, folks, they're increasing their dividend by 9%. That's just phenomenal. All right, next one. Next Era Energy, ticker symbol NEE. They have just announced yesterday, the 17th, that they're increasing their dividend to 46.75 cents per share. This is a 10% increase. Whoa. You know, these guys that we're looking at, they are going gangbusters on their dividends. Right now, I don't have any shares in any of these companies. I used to be a Coke shareholder, and I want to get back in very soon. But I am impressed with these dividend increases for Louisiana Pacific and Next Era Energy. A little background on Next Era, and you can read this at your leisure, but they're a utility. They describe themselves as a clean energy company, a leading one, headquartered in Juno Beach, Florida, and they own a company, a big utility called Florida Power and Light, America's largest electric utility, selling more than power than any utility in the country. Wow, they're even bigger than like Con Edison, which is probably the most famous, prominent one. These guys are bigger, and they sell to 5.8 million customer accounts and more than 12 million people. They have a big footprint. That to me tells me this is a very substantial company, a utility company. All right, looking at the numbers. Nice dividend yield, 2.46%. It's a little bit below their competitors, about 0.9%. Payout ratio is good. It's in that 20 to 60% range. Oh my goodness, look at that dividend growth rate for 5 years, 11.59%. This is perfect. This is what I want to see in a dividend growth investment. Um, a healthy, sizable growth rate and a decent yield, not a massive yield. Um, this to me tells me their strategy is to have a sound, stable yield and a growing growth rate. They want to be a company that will pay out increasing dividends year after year. And by God, they have. Look at the dividend growth streak, 27 years. It's amazing. And that dividend growth rate is more than double its competitors, 11.59% to 5.4%. Unbelievable. You know what? I would feel very comfortable just jumping in on this one just based on that. I'd probably look a little closer, look at the earnings and the cash flow, but I'm comfortable right now based on that. Um, the beta is decent, but I'm going to get to that in a second. Let me talk about the price. Price is $76. It's fluctuated between 67 and 91 the last year. So if you look at the screenshots from Seeking Alpha, the top panel is for the last 12 months. Uh, they still ended up in the green price wise, a little less than 1%. Um, you know what? It's a utility. So I don't expect big price appreciation. But as I say that, take a look at the second panel, which I love it. The last 5 years, they've gone up over 100%. So, wow. Um, you know, you take a look at the PE ratio and it's higher than its competitors. Well, that's why people are buying it and they're bidding up the price. But it's a good company. Um, they got a huge market cap, 149 billion. You know, compared to Coca-Cola, which is a global juggernaut of a company, these guys are about two-thirds the size of Coca-Cola. This is a utility company. And you know, when you read the background, go back and look at it. They actually have a footprint in other states, not just Florida. I think I read New Jersey and New York and some other places. Take a look at that. They are a big company. Um, Look at the beta. The beta is less than 1. So relative to the S&P 500, it's a more steady, stable company. Now, I do provide two betas, 24 months and 60 months, just like I did with Coke, because I like to see trends. Now, this trend is telling me, well, yeah, the beta is less than 1. That's great relative to the market, but it's gotten bigger. Well, yeah, it has. Um, the last 24 months have been like no other time in history. We had COVID, we've had inflation. So things have been a little bit out of whack. That's why I like to look at a longer time horizon. I like to look at both, but I like to have that longer time horizon. I like to look at 5 years or 10 years. So that's why I included 5 years here. The beta is 0.44 for the last 5 years. Uh, just like Coca-Cola, this is probably a marquee brand in the utility industry. It is one. Um, People are buying it. They like it. They have stable, steady, growing, consistent, long-term dividends. I'm in. I'm in on all three of these. I think that these are all good buys. And bottom line is these three companies are all increasing their yields, their dividend yields. The dividend growth rate is continuing. So their dividends are continuing. And this is good for people like us who love dividend growth investments. Folks, thanks for staying with me through this video. I greatly appreciate your time. And I would again ask if you would like the video and subscribe to the channel. And do your due diligence before you make your decision. And until the next video, good night and God bless.